Assalamu alaikum wa rahmatullahi wa barakatuh, and welcome to episode 3 of the Halal Investors Podcast. My name is Umair Shakoor, and I've got brother Rehan Ahmed here with me again. So welcome and Eid Mubarak to you, brother Rehan.
Wa alaikum assalam wa rahmatullahi wa barakatuh. Jazakallah khair. Eid Mubarak, brother Umair, and to all our wonderful listeners. Alhamdulillah, it's good to be back.
I'm going to get straight into it. Hot topic of today and this week is that after a small pause, the rates have started rising again. And one of our listeners actually reached out to me and requested that we discuss this topic. So I'm just gonna ask you, in this time and facing this situation, whether you've got a mortgage or you're renting and those costs are being passed down to the renters, what are some smart ways that people, and Muslims in particular, who are trying to avoid interest, can use to try and beat the system or still navigate, through these times in the face of inflation?
Mm-hmm. No, it's a great question. Bismillah, salatu wassalam ala Rasulullah, sallallahu alayhi wasallam. So it is, to set the scene, we're recording on a Friday here, and the RBA this week, so the Reserve Bank of Australia, announced that they had another quarter point, or 25 basis point rate hike. The United States also, the Fed just announced a 25 basis point rate hike as well. So they're kind of synchronized in that monetary policy that they're trying to push out. It is getting tougher, right? Because there's two forces that not just Muslims, all people are generally facing. One is the increasing cost of living, and the other is the increasing cost of housing, right? And so both of these are inputs to the cost of living, but they affect different people in different ways. And, if you've got a mortgage and, it's a variable rate mortgage, or you're soon to come off your fixed rate, many people are in for a big shock, something that I'm sure they're trying to prepare for, because rates have risen, 2x or more, depending on where you live. And, there's been a lag as well between, I guess, mortgage cost going up and rental rates. So rental rates are definitely lagging in this case. So rental is now a little bit more affordable than getting a mortgage for a typical property in Sydney, for example. So people need to keep that into account when they're making these decisions. It might actually be a better time to stay renting right now, as opposed to like running into a potential mortgage. Investment would make more sense in this climate than to buy to live in, because just the sheer cost of servicing a mortgage is much higher than it used to be. However, the price of housing, or the housing prices, haven't really declined in the proportional to the increase of interest rates. Yeah, so you've got like multiple factor increase in interest rates. However, obviously houses haven't gone down 50%.
So people are still okay to buy with those high interest rates. Like, say, interest rates are what, 2% at some point in time. Now they're 4%. Me as someone who's looking for a house, I'm still jumping in. That's what the prices are showing in a way, if they haven't dropped.
Yeah, it's interesting. The prices, I think people just are always loath to sell real estate at a discount. And so, there's definitely stickiness to the upside on real estate. And, we haven't reached that point where we've got mass default yet. People are churning through cash.
Yeah.
People are taking up second jobs. There's obviously the gig economy. There's Uber. There's ways that people are trying to cope. They're cutting down on their spending, right? And that's how people are trying to manage in this situation. But these things take time. So, we've only had really a year where these interest rates have been going up in this fashion, and the true impact of that will probably take another year to actually process through the system. A lot of housing prices are being held up by investors, not people who necessarily want to live in that property.
Yep.
So investors, especially real estate investors who have long time horizons and a lot of equity, can ride it out because they can just, like you've experienced as well, they can just jack up the rent.
Yep.
Right? And make it the tenant's problem to try and service it. So because there's so many different factors and so many different players in the residential real estate space, especially, it's kept buoyed by that.
Yep.
Whereas I think, especially in the United States, but to some extent we'll see it here as well, commercial real estate hasn't really recovered from the COVID kind of crash, right? So commercial real estate was mostly empty. These are long-term leases that people have in commercial real estate, office buildings and so on. But you and I both know, like, not everyone's back in the office the way that they used to be pre-COVID. And that's kind of here to stay. And so we're coming to terms with the commercial real estate crisis, especially in the United States, in places like New York and San Francisco, which historically were, never fathomable.
Yeah.
So that's leading into, a part of this banking crisis as well. So it is adding pressure to banks, knowing that, the value of commercial real estate, as well as the cap rate, meaning the return you expect, the return you expect on commercial real estate, is also falling dramatically. So that's a interesting place to be for that entire lending sector, because you understand real estate is all linked to lending. Most real estate purchases are financed; they're not bought on cash. So it's a lot more. The banking sector is a lot more sensitive to negative news in the real estate space.
Okay, and that topic you touched on, banking, I'm going to circle back to that a bit later, but just something you just said now around, real estate market or investing being, linked to lending a lot more. My question is, what is someone who's cashed up or an investor in property, they're not too much affected because they're passing on those costs to their tenants. But what are other avenues that someone who still wants to invest in this time? I know you touched on what people can do to cope with rising rents, interest rates, and getting a second job. That's just to, I guess, kind of stay or maintain status quo in the face of inflation. But for someone who's trying to get ahead of the game or grow in this scenario, one, if you're cashed up, what do you do if you're investing in property isn't the right thing to do? Or two, if you're not really cashed up, but you've got, maybe a budget of, say, $500 a month or or $1,000 a month that you would potentially, just save as cash. What avenues do you think they have in the current time to invest and try and grow their wealth?
Yeah, it's a great question, mashallah. So if you want to preserve your wealth, right, that's one thing, because we're in an inflationary environment. If you have an extra $500 a month or $1,000 a month or what have you, now, in a year's time, if the inflation rate, currently is 7%, some places it's 9-10%, that will eat away if you just put it on your mattress or put it in a bank account, right? So that's one thing. How do you try and outperform in a high inflation environment? It's a tough one because different asset classes will move at different times, but generally in a high inflation environment, you want to be invested in things that kind of contribute to the inflation itself. So you're on the right side of inflation in your investments, right? Okay. So if it was energy prices, for example, so oil, right now oil prices are actually deflationary. They're going down. So we're out of oil, right? Again, but through the market timers that we look at different commodities in our investment platform and allow Muslim investors, or even if you're a non-Muslim investor, to pick right asset classes at the right time and try and catch them on their return.
Yep.
Right? Because we'll find that asset prices will be range bound during this period, because it's a period where we're seeing a lot of deflationary forces, and that means deflationary forces means that prices intrinsically of goods will fall because demand is falling, right?
Yep.
So as the central banks of the world enact their monetary policy, they want to create tightening. And when they create tightening, that means liquidity is being removed from the system. And when liquidity is falling, it's usually not a good thing in general for the stock market. So I wouldn't be investing in the broad stock market, for example, right? It's in general a bad thing for risk assets when liquidity is being removed. With interest rates still moving, obviously being in the bond market is an interesting place. When interest rates go down, then the value of bonds go up. So, right now the market is predicting, it's pricing in cuts from June or July. Obviously the market changes its mind every day, but that's what we're seeing right now off the back of the most recent rate hikes. So if someone has some capital to deploy, I still think using the stock market as a conduit to get access to different asset classes, whether it's lithium, whether it's copper, whether it's steel, whether it's iron ore, whether it's even, good old-fashioned oil. There's many ways that a person can get exposure to certain commodities that will come into demand cyclically, right?
Yep.
So at this point in time, it's a good idea to be tactical. I do think a liquidity crunch that we will see soon enough, especially with like the U.S. government coming to terms with lifting their debt ceiling again, because it's that time of year again where they've hit their debt ceiling. They need Congress to approve an increase to the debt ceiling. When they do that, then they'll issue a whole bunch of debt, and that takes money out of the system, right? So because so people buy debt, that money goes onto the Treasury General account and it leaves the money supply.
Yeah.
Right. So the broad money supply. So there's a lot of forces right now. What I'm trying to I guess articulate is that we need to be cautious. It's not a time to go kind of all in on any particular asset class, because things will move very, very quickly and most likely will remain range bound. So from here, I'm not predicting like the bull market starts today. Yeah. So being tactical in your asset allocation is good. That's what we're trying to help our clients do. Obviously, if you've got a 15-year time horizon in your pension fund, your superannuation fund, then it's a very different game for you. And for you to be averaging in to new lows is a good thing, and you can continue on with that strategy as long as it's a long-term capital. It's 15 years.
So that was going to be and thank you for bringing it up. My next question is, yes, we've touched on how does someone navigate the current situation, but someone who's got 5, 10, 15-year horizon, how much of a difference would it make for, say, a passive investor who just set and forget? Do they also need to maybe pay a little bit more attention, or for them it's maybe like a little blip in their investment journey because they're going to look at it maybe 10 years from now?
Yeah, I think in the long arc of history, it'll be a bit of a blip. And, the S&P 500 has been very resilient even over the past year now, right? So, we were down around 20% last year, and we've had somewhat a recovery this year. So stocks have been quite resilient, and we haven't seen like a major collapse last year or this year. Although it has had a major impact on overall portfolios because we have had a bond market crash. And that's, it's relative, but that's something, because interest rates have been going up, bonds go down. And, and the fact of the matter is bonds and stocks went down together last year. So it is a significant portion of people's historical portfolios, because that hasn't really happened in near history, right? So that's the historical part of it. I think for long-term investors, if they're DCAing into the market, I think in 15 years' time you'll be fine. That's just my view from where we are today.
Yeah.
But if you just bought the SPY today, as in the S&P 500 today, or the halal equivalent of it, it is a real possibility that it'll kind of hover around this point for another 5-10 years, possibly. So we could have like a dead decade in that sense, where things just hover around, go up and down, but don't like continue the trajectory of growth that we've seen over the past 15 years, because we're coming into a very different monetary and inflation rate regime.
I guess it's better than living under your mattress where it's just kind of depreciating due to inflation.
That's, yeah. I mean, if I was to keep some amount of wealth for another 15 years, one of the worst places to put it would be cash. So definitely you need to be earning some kind of yield on that. And as Muslims, obviously we're not just going to put it into a bank account that's earning 5% or 6% interest, because that's riba is impermissible. It's problematic. So we're going to have to find equivalents in that. And there are fixed income equivalents, even through the stock market. There are things called Shakoor that you can get access to. There's real estate that people can put into. So people are investing in real estate so they can get that 8-9% return, right? Provided you know what you're doing with real estate.
Okay. Jazakallah khair. I'm going to touch on that, the harmful effects of riba and interest later on, if we get a chance today. Just wanted to go back to that topic of banking. And, recently in the news, there was another buyout with JP Morgan, buying the US First Republic Bank. What led to that? And is it all based on, what we discussed in the first two episodes of just the confidence and, the buyouts and the bailouts that happened with the other two banks? Is this something similar? Is this a complete different event that we now need to watch out for?
No, it's a great question. We just mentioned the name First Republic last time because it was a bank that was kind of in a similar situation, not the same situation as Silicon Valley Bank, but it was a bank that everyone knew was having some trouble. So we were predicting that it was gonna collapse, but it took this time for that to happen. And what's been happening between that being a couple of months ago to now is that there's something akin to a bank walk happening. We know what a bank run is, which is when depositors flee out of fear. A bank walk is basically what we're experiencing now, is people slowly moving their funds out of banks in search of higher yield. So it's more about greed than it is fear.
Okay, so it's not an anticipation that I won't be able to take my money out. I just want to put it in a better place, a better return.
Correct.
Okay.
And so banks have been having these very low interest rates on their deposits, which is now no longer good enough.
Yeah.
And because they're now literally competing with the Treasury. They're literally competing. The Fed is causing the Treasury to compete with back deposits, because now people can move their money from a deposit or checking account and put it into very quickly with a mobile phone app into a money market fund, which just buys treasuries and recycles them. And so that way they get a return, and in some ways it's considered actually a safer asset as well. So there's little reasons for people to stay in banks that aren't providing high returns. The problem with banks like First Republic, who just got bought out by JP Morgan, is that it's more of a generic issue. It's not something specific to First Republic, really. Like, they want to play it like it is, but this is actually a systemic issue. Most banks would have, on average, an income from their loan book of, let's say, 3 to 4%, right? As they're adjusting over time So for them to offer 5% on deposits doesn't make sense for them because they'll lose money.
Yeah.
Now some banks are doing it, and that's more like a survival tactic because at least you can keep your deposits, right? So it's a really tough place for these banks, and if you're in that banking industry, you've got your work cut out for you because you've got to wait until your loan book rolls over so you can then replace it with higher returning loans.
Yeah.
So then you can offer the competitive rate on your deposits.
Yep.
So that you can compete with the treasury, right?
Yeah.
And the reality is the whole situation has been created by the Federal Reserve increasing interest rates so quickly, because how can an institution that borrows short-term, lends long, cope with going from 0.25 on the rate to 5%?
Yeah.
In 1 year? How on earth could any bank really cope with that? And so you've got these massive banks like JP Morgan, considered like the world's biggest, but those banks have so many different businesses. It's a conglomerate.
Yeah.
It's not just a bank. You can't compare JP Morgan Chase to First Republic or Silicon Valley Bank, which just do banking.
Yeah.
Right? Mm-hmm. So they have multiple revenue sources and that can balance out what they're facing. So obviously they've also suffered because of this interest rate rises, but they can make up for it, and they've got enough reserves to survive. Now JP Morgan has come in, and first of all, the first thing that happens whenever one of these banks starts to go under, obviously the stock price is the first tell. Stock price just plummeted for First Republic. We're watching it plummet for PacWest now as well. So there's a few other banks that are now looking like the next ones to go.
Okay.
But with First Republic, the stock price just died, and then the FDIC came in and seized it. So they take over the bank, and then they try and find a buyer, right?
And what's in it for, say, the likes of JP Morgan? Are they going to turn around, change the business model? Why would they buy something that's failing?
Yeah, it's a great question. So they buy it when it's cheap enough. And so what they're doing is they work with the Fed. Now, there's a really perverse incentive now for banks not to help each other, because what is happening now is what at the FDIC came, obviously couldn't find a buyer. So they took it into receivership to themselves, and then they get someone like JP Morgan or Bank of America or anyone to come in and say, give me bids for the assets.
Yep.
And so now the bondholders get wiped out. So if you were a bondholder of First Republic, you get zero. You get zero on the dollar, right? If you were a shareholder, you get zero on the dollar, right? But if you were a depositor, right, that's where the FDIC will come in and negotiate with JP Morgan and say, hey, can you cover some of these deposits for us to make sure that, if they withdraw, you cover that.
Yeah.
And so they'll do like a loss sharing split. So it's such a good deal for JP Morgan because the FDIC right now, they kind of said, okay, we'll take 13 billion of the loss, but we guarantee up to 80% of the deposits, right?
Yeah.
Now, obviously, First Republic's assets aren't all worth zero. They just need time, right? So all they needed was time. So JP Morgan can pick and choose which assets they love. They're like, these are great assets. Yeah. We'll take those. We'll write these ones off, and that's your problem. FDIC covers those. And so in a way, it's like getting something for free. Yeah?
Okay.
So JP Morgan's not for free, but like dirt cheap, much less than what its cash value is. And so JP Morgan gets to swoop in after receivership and say, all right, I'll take those and those and those, and I'll leave these.
Yeah.
Thank you very much. And we've seen like JP Morgan's stock price go up. They're expecting to make over $20 billion out of the deal, right? So, they're like an apex predator. So these big banks, they'll come in, they'll swoop in, but before there was an incentive to try and get someone to buy a bank cheap, right? When the stock prices crash, it's worth heaps less than what it was. But now everyone's watching like, if we let this thing fail and let the FDIC take it, we'll get it for pennies on the dollar. We'll get it for an even better rate than what we would have if we if we swept in and bought it at a cheap market rate.
Yeah.
So you wiped out all the bondholders, you wiped out all all the stockholders. It's actually a crazy scenario where basically the FDIC is creating an incentive now for banks not to help each other.
Yeah.
Yeah.
Okay.
So you watch your neighborhood bank go down, you watch them go down in flames, and then you'll come in and say like, all right, I'll pick up from your carcass now.
Yeah.
You know, I mean, it sounds pretty evil and sick, but that's kind of the incentive that's now being created by how they're dealing with this crisis. So yeah, we're gonna see what's next. I mean, it's just shocking to see what's going on, but you know, people like JP Morgan or banks like JP Morgan are obviously profiting from this.
Yeah. Another one of my listeners also asked me to I guess touch on this topic with you. You did mention you know how not all asset classes are going up or down, and you mentioned petrol is, you know, at the moment on a downward trajectory. Now, a few weeks ago, you know, I was hearing about the whole US petrodollar fading and how that's kind of being championed or challenged by Russia and China. Are you able to touch a bit more on that topic?
I can try. So, you know, specifically, yes, I mean, it's interesting to watch, right? If you read some of Ray Dalio's work, and he's been, you know, contemporary commenting on what's happening with the fall of the reserve currency, which is currently the United States dollar. It is fascinating that, you know, we're going to have kind of a multi-reserve world. The US dollar will remain reserve currency. Actually, reserve currencies historically remain reserve currencies even after a while after the decline of the empire that owns the currency, that mints the currency. So the US dollar will remain in power or be the world's de facto reserve currency for quite some time. But in the medium term or short term, so Stan Druckenmiller, who's like one of the most successful investors in the world, historically has one of the best track records. He recently disclosed his current position. It wasn't financial advice, but he was short the dollar, meaning betting that the dollar will fall. I'm not saying disappear, but just fall in value. Long gold. Okay. So, you know, betting towards gold. So, you know, that's an interesting position for people to be in. I think it's true. I mean, central banks have been buying up gold like crazy over the past 2 years.
Yeah.
And they've been doing it secretly, but it's known. And so the gold price, I think, just hit an all-time high. It's at a reasonable peak at the moment. So we're seeing that gold is coming in to replace the US dollar in many cases as a reserve, especially for countries that aren't necessarily very close or very friendly with the United States. Okay. You know, so Russia has obviously been buying a lot of gold. China has been buying gold. You know, other central banks have been buying gold. The US has been buying gold as well, right? Okay. So there is a kind of shoring up of reserves in the world, and people are trying to diversify their exposure. Yeah. Right. Because if the US dollar, you know, if the US goes to war, right, which they're kind of like doing a bit of showmanship with China and talking them down. We're going, you know, into an election year as well. So there's a lot of brinksmanship with the United States talking down China and trying to like rally political support for themselves. But in that process, they're going to aggravate the relationship with China. They're not going to appease it. Likewise, relationship with Russia as well. So in that process, if things are going to get worse between Russia and China and the United States, it's in their interest to try and insulate themselves from the US dollar. Yeah. Because, you know, the US has proven to weaponize the US dollar. Yep. They've proven to weaponize the reserves that other countries like Russia were holding in US dollars by confiscating those reserves. So a lot of people now have a bit more caution when dealing with the US dollar. So they need, like the yuan, for example, to act as like another semi-reserve currency, and we're going to have kind of this multipolar world where you're going to have the yuan having a greater role. You're going to have other countries start to trade assets like oil and energy, natural gas and things like that, in currencies that are not US dollar denominated.
Yeah.
And even gold being traded non-US dollar denomination. So it moving towards that kind of multipolar world, right? You got Brazil, India, China, Russia, and even parts of the Middle East, opening up ties and trade relations, and diversifying away from the dollar. All of that will add to dollar weakness, right?
Yeah.
And so that's kind of what we're seeing. Gold go up, dollar go down. Bitcoin holding its value as well. It's not crashing in this scenario because the Bitcoin itself has been kind of another reserve diversification unit. I'm not saying central banks are buying it, but what I'm trying to say is when people try to fight inflation or trying to diversify where their wealth goes, Bitcoin is playing a role in diversifying. That I'm going to hold some US dollars, I might hold some gold, I might hold some euros, I might hold some Bitcoin, right? So people, when they're trying to protect their wealth from everything that's going on, especially with the rapid increase in inflation, it's playing a very different role to what it used to as a full-blown risk asset, right? So it used to be like a tech stock, or it used to be like a fintech stock. You could think of it that way, but right now it's behaving very differently.
Okay. And just finally, and we'll just touch on it very quickly because we're almost at time. But just I mentioned earlier that I wanted you to elaborate a little bit more on some of the harmful effects of interest and why we are where we are today. I know there was a while back you were writing something around how it was banned in previous civilizations and how it led to the fall of a number of big empires. Intrinsically. We'll touch on that in length in a future episode. But if you could just maybe just talk about it just a little bit in the context of what's happening.
Yeah, I mean, I have a contrarian view on this, especially if you look at what contemporary economics says about the relationship between interest and inflation. In the short term, the Federal Reserve at the moment is trying to fight inflation by increasing the interest rate, right? And in the short term, that can, try and cause a retraction in the demand for goods, right? So as tightening happens with less liquidity, less lending that is available, and therefore people can buy less stuff, and therefore you can try and have a reduction in the in the price of goods. So that's one way to look at it. But another way to look at it is if you have an interest in a society, in an economy, the whole system is based on interest, then you need to print to pay the interest. All else equal. All else equal, the United States has to print money to pay their interest payments because those dollars have to come from somewhere. Yeah. And so over the long term, the US dollar, like over the past, since 1920s, it's lost 98% of its purchasing value, right? So, like over the long term, it is bound to fail, right? Because you need to keep printing in order to keep the system going. You need to keep the economy tilted forward, right? And what happens when you have an income shock, right, which happens from time to time, you can't absorb it because you need to keep making those interest payments, otherwise they get default. And the only way they're treating default right now is by just refinancing, so you just kick the can down the road. So that's what's happening, unfortunately. So an interest-based system, like at its birth, right, has kind of like a date of death, right? It's destined to fail because, as Albert Einstein said, compound interest is the greatest force in the universe, or so to speak, as I'm paraphrasing, but he said that because there's nothing that can stop it. You can't reverse the genie once it's getting out of the bottle. The reverse is too painful for you to because that's people's assets that you have to write to zero, right?
Yeah.
When you default on a debt, that's a person who thought they were a billionaire and they're no longer a billionaire.
Yeah.
Because they've lent it out and it's gone.
Yeah.
So all they can do is just refinance and add interest to interest, and it compounds, and you're destined to create a society where people's wealth is falling, and we're experiencing it in real time right now. With 7-10% inflation, we're really living through some of the negative effects of that inflation. It is a feature. Inflation is a feature of an interest-based economy, and so sometimes they want to make it sound like a good thing and so on, but at the end of the day, we are destroying people's wealth. And if a person 50 years ago worked really hard and saved up enough money to retire on, right?
Yeah.
Now that money can't even get him through 1 year of his life.
Yeah.
Is that his fault? What did he do wrong? Right. But someone else made those decisions, like the central banks and so on, to have an inflation target, to actually create inflation.
Yep.
Right. But an interest-based system, it's a necessary feature of an interest-based system. You can't have an interest-based system and have deflation. It doesn't work.
Yeah.
It doesn't, you're going to have defaults, right? So they need the inflation to keep going so that they can afford to pay the debt in the future with cheaper money than it was in the past. It's a type of default. So you got to understand, inflation is a type of default because you're giving back less than what you gave out. Yeah, exactly what you took in the beginning, right?
Yeah.
But in dollar terms, it's the same or more, but you've devalued it.
Yeah.
So it if I was to give you a gold bar and then you pay me back in dollar terms, now you're giving me back half a gold bar. Yeah. To me, you've defaulted on my debt.
Yes.
Right?
Yeah.
But, because we're dealing with this fiat money system, it's funny money, they can say, oh, I paid you back. But that's how the U.S. government is actually funding half of its operations, is through debt. And they need to make sure there's inflation. So it's cheaper for them to pay off. You know what I mean? I mean, it's just, it feels like a bit of a scam, and may Allah allow us to move towards more sound, wholesome monetary systems that, allow the distribution of wealth fairly, right? I'm not talking about in a socialist way. I'm just saying that wealth, for it to benefit, has to flow, and it has to be distributed wide enough so that people can participate in the economy. Otherwise, people will fall off the edge and they'll just become a burden to society because your monetary system itself is stealing from them.
Yeah.
They had enough money to live off 10 years ago and now they don't.
Yeah.
And so that's something that we need to work towards, inshallah. And it's my dream. It's, inshallah, our mission that if we can partake and inspire people to first protect themselves from the current monetary system by understanding it, right? Understanding money. And then hopefully sow the seeds for building a fairer economic outcome for everyone, right? Not just the lenders just benefit and the borrowers always remain borrowers. We need to lift people up and level them up, inshallah.
And that's the perfect way, I guess, to end your answer, because we're at time, and it was something that I was going to close off with anyway, is, setting the theme for, I guess, some of our future talks, and how, one, obviously today was talking about interest and a lot of negativity, but on the horizon, like you mentioned, there is a lot of positive ways, inshallah, with, I guess, the way Islamic finance works, I guess educating people on some of those principles and concepts, how everyone, not just Muslims, but everyone else can also benefit if they can implement some of these. And like you said, everyone benefits and everyone grows, and everyone, the economy in general, moves forward, rather than having, a small percentage win and everyone else lose. So Jazakallah khairan for your time, and your answers very eye-opening and very educational for me, and I'm sure for a lot of listeners. So this was episode 3 again, just to recap of the Halal Investors Podcast. Please, if you have any feedback, questions, suggestions to any of our listeners, reach out. We're always willing to discuss anything and everything. And if you, give us notice ahead of time, then we can, plan and prepare as well accordingly. So this is again Umair, Shakoor and Rehan Ahmed signing off. Until next time, inshallah. Assalamu alaikum wa rahmatullah.
Assalamu alaikum wa rahmatullahi wa barakatuh.